Hello, everyone. Good afternoon. Welcome to the Final Bar. My guest today is Tony Dwyer from Canaccord Genuity. He's going to update us on a point of view he shared earlier in the year, also looking at how the current market relates to some previous bull market cycles. We're going to look at the S&P today, sort of a digestion day, right? After a couple days of directional movement to the upside, today went that painful but often third direction sideways. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets. We focus on the message of the charts. We focus on key messages of price, breadth, and sentiment. And again, as many of my mentors have reminded me earlier on in my career, the most important thing to focus on is price. We can speculate about what could happen, what should happen, what would happen, given different alternate scenarios. At the end of the day, price is what's most important. If you know nothing else, focus on trends, focus on the momentum shifts, focus on what's working and what isn't. And I would argue that your best toolkit to understand that is the toolkit of technical analysis, focusing on the charts and how these trends are evolving. And what we've seen with the S&P 500 threatening new all-time highs again this week, pressuring to the upside, but not quite following through all the way. We have days like this sort of digestion days, which I sort of think it was, you've had your big meal. Monday and Tuesday were sort of the big meal. Today's sort of the time where you take a break and digest before you jump in the pool. And the question is, do we jump to new highs through the remainder of this week, or do we jump into the deep end and start to rotate lower and retest areas of support? We'll try to differentiate by looking at some historical parallels and see what we can come up with. We have great guests to help us along in this journey of market analysis. Today, I'm excited to have Tony Dwyer join us on the show once again from Canaccord Genuity. Tomorrow, on Thursday, the 24th, we have Bruce Frazier. Bruce is the host of Power Charting here on StockCharts TV, a Wyckoff expert. Next week, on Tuesday, the 29th, we have Tony Zhang from Options Play. Does a fantastic job making the complex world of equity derivatives seem a little less complex. And then on Wednesday, June 30th, Clint Cowles, who's a market strategist at TD Ameritrade, coming to us from Minneapolis. So some really good guests coming along the way for us. Let's get to our market recap today. We're going to recap the markets. We're going to talk with Tony a little later. We're going to do a segment called Compare and Contrast. We'll look at two stocks within the financial sector, talk about some of the subtleties between stocks in those groups and how you can start to differentiate between them. For our market recap today, let's look at the S&P down, really just a rounding error below zero. It was essentially a choppy day. Most of the day was spent in the positive, but some distribution there in the last 30 minutes pushed the S&P just a little bit negative, closing just around 42.40. Mid caps and small caps had done better, and small caps really were strong through the course of the day. It certainly felt like sort of a follow-through day, but by the close, everything sort of gave back. And again, these finished sort of a rounding error above zero, and the VIX is around 16.3. Looking at other asset classes here, yields increasing, and you can see that financials finished in the positive, higher yields helping that. This is after yesterday, where there was certainly a drop in the 10-year down to around 147, which we hit earlier in the day, back up a little bit to 149, and TLT bond prices down about 0.25%. The dollar just a little bit above flat for the day. Gold was a really interesting day. If you look from a technical perspective, you sort of gapped higher out of the open, accelerated to the upside, but then the entire day was spent sort of falling down the stairs. We finished at the weaker part of the day, so essentially flat for the day. But it was an exciting trading day of relative movement. And silver up about a 1/3%. Cryptocurrencies overall recovering from recent weakness in the last 48 hours, really dropping pretty significantly, with Ethereum testing 1,700, Bitcoin touching 29,000, so getting down in the 20s for the first time in quite a while. Recovered a bit for sure going into today, but rolling over at the moment just below 33,000 where we're at. Let's look at a chart of the S&P 500, sort of reorient ourselves to where we're at here. So here's the situation. I would argue with the S&P. The acceleration phase for stocks was into April. From April on, we see a condition of a weakening uptrend. Still an uptrend. We're still managing to make higher highs. That is totally fair. We're retesting all-time highs again this week, but the momentum has been really dissipating, right? So if you look from the April peak, the strongest momentum has been in mid-April. From there on out, pretty much every peak that you've seen, every subsequent rise and new highs in the S&P has been met by weaker and weaker momentum. So what that tells me is that the upside momentum is waning. We've talked about the percent of stocks above their 50-day moving average. It's around 50%. So the S&P is testing all-time highs, while about half of the S&P is below their own 50-day moving averages. That's not the sign necessarily of an overall healthy bull market environment. That's more of a market that's showing a lot of weakness under the hood that's not really being reflected in the S&P itself. Having said that, right, I mean, the S&P has given us plenty of opportunities to signal an exhaustion in the uptrend, plenty of opportunities to signal a reversal more to the downside, and every one of those opportunities has not seen the follow-through that you need to really turn more negative, right? And I think the 4.5% drop here in May, when we broke down through a swing low, but then that was it. We bounced right off of the 50-day moving average. A week later, we tested that same level and bounced off the 50-day once again. Again, this week or in the last Friday into Monday, tested the 50-day moving average one more time. We've reverted back and then pushed back to new highs. This trend line taking the lows from October and March and May was broken going into Friday's close, when we finally closed below that trend line for the first time. But then we came right back up, and we're currently right back at that same trend line. So, while what I've talked about it with this market, it's not that you're seeing signs of climactic downside potential. You're just not seeing. You're seeing signs of limited upside. You're seeing stocks that are breaking down. You're seeing stocks that had been doing well in cyclical uptrends that are now pulling back. And this could certainly be reloading before we break out to new highs, or sort of the summer doldrums period, seasonally weaker part of the year. We're more in a sideways direction, and while the market is sort of dribbling higher, it's not really accelerating to the upside. Now, having said that, I mean, some of the charts that I think are really key to look at. Chart of Apple might be one of the most important ones. We talked about that earlier in this week, but I focus on the short-term chart of Apple. It's interesting that you had the failed breakdown here in May and June, right? The symmetrical triangle pattern of lower highs and higher lows. We bounced off of that lower boundary a number of times, but then really the first week in June felt like this could get really ugly really quickly. And we highlighted this chart at the time. We saw it breaking down through the lower boundary of that symmetrical triangle. And my comment was, we need to get, do we break down? Do we get confirmation? Do we get validation of that breakdown? By getting through the 200-day moving average, we closed below it one time and then immediately reverted back to the upside. It showed that people were buying in on the weakness of that short-term pullback there. We then came back into the pattern. So that is what you'd call a failed breakdown. It was a breakdown that started to materialize but didn't really follow through. It didn't really get that confirmation pattern of breaking down through the previous swing lows, breaking down through the 200-day moving average, indicating more of a broader sell-off. Now, all of a sudden, we've come to the upper end of the pattern, basically, and have broken above a trend line, taking the highs from January and a high from April. We've now broken this week through the upper end of the boundary. And when I'm looking at today, right, so yesterday was the breakout day. Today, we're not going any higher. We're actually closing a little bit lower. And I tweeted earlier today, this would be perfectly poetic if you had a failed breakdown and then a failed breakout a month later, where Apple is literally unable to get out of this pattern and indicate a clear future direction. The S&P, I would argue, goes to higher highs and accelerates further upside from where it is today if charts like Apple break out of this pattern, if they get above the April high and really indicate less of a I'm not sure chart and more of a obviously you would need to own this chart because it's clearly in an uptrend. I don't think Apple's there yet. And so I think looking at some of those stocks and seeing if they're able to resolve to the upside certainly is pretty important. Now, it's worth noting that Other names within the group of FANG stocks certainly have already done that. Facebook is probably the best example of a chart just in a strong uptrend. And, again, not knowing anything or not caring about what else is happening in the market, if I'm given a chart like this and I'm shown that there is a basing pattern for about 6 or 7 months, we broke above it, tested that from above a number of times right around the 50-day moving average, have now reverted back to make new all-time highs. And it's also making a new 6-month relative high, and it's not yet overbought. That is a pretty consistently encouraging chart. I mean, there are very few scenarios where I would not think that's a decent chart that you probably want to own rather than not own, because it's a chart that's working. It's making new price highs, new relative highs. It's broken out of a base, which shows that there was a consolidation phase, and now we're back into an accumulation phase, sort of firing on all cylinders. And the fact that it's not yet overbought on the chart there is also fairly encouraging as well. So charts like Facebook make me feel like there could certainly be more upside from where we're at. A little later, when we get into things like the cyclicals, particularly we're going to look at a couple financial stocks, you'll see how they're very, very much in pullback mode. And it's not as much a breakout to the upside like you're seeing in Facebook. It's not as much a consolidation phase on the upper end of the range like you see with Apple. It's more of a pullback. It's pulled back to the 50-day or even broken below its 50-day moving average. And the question is, if this is a long-term uptrend and this is just a quick pullback and we're riding the next leg higher, we're kind of there where those stocks would start to work. My question is, do those support levels hold that we've identified in recent days and recent weeks? We'll look at a couple of those stocks a little later in today's show. We need to take a quick break. We'll be back with Tony Dwyer from Canaccord Genuity. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market activity using the language of technical analysis and behavioral finance. As a reminder, we'll do another mailbag segment on Friday's show of this week, and we'd love to answer one of your questions on the air. Nothing is out of bounds. Anything about market history, technical analysis, behavioral biases, particular charts that you're looking at that you want to understand better, just let us know how we can help. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. Go to our YouTube channel if you like, and you can put a comment below any of the videos that you're watching on the Stock Charts channel. We'll gather all those questions and hope to answer one of your questions on Friday's show. Also, as a reminder, if you want to follow more of Stock Charts TV great content, including wonderful guests like Tony Dwyer and others, fantastic hosts, all the great content we have on our channel, go to stockchartstv.com, use your email, set up a free account. You can start watching all of our content immediately. We're also on all the app stores. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Tony Dwyer. Tony's been on this show a number of times before. It's always a pleasure to have him on. He's the Chief Market Strategist at Canaccord Genuity, also the founder of Dwyer Strategy. Tony, welcome back.
Thanks, Dave. Great to be with you, buddy.
So we're starting with a chart looking at money supply. Basically, this is liquidity has been, I think, on the top of a lot of investors' minds as we've seen this sort of relentless uptrend. Update us on what you're seeing here.
Yep. Okay. So this, I wanted to show your viewers something that I've showed before because it was so extraordinary to the upside, where you've had real liquidity, excess liquidity, which this chart shows you money supply growth plus equity and bond mutual fund growth. So readily available money minus industrial production growth, what is needed for economic activity. So it gives you a good idea of where the money's going. Coming out of the recession and the pandemic low in 2020, they threw all the money at it that they could. They do it every cycle. Look at 2009 and 2010 on here. It had the same kind of move off that low. Every recession, Dave, is unique, right? It goes in, we had the S&L crisis, we had the dot-com bust, great financial crisis, and now the pandemic. It's always unique why you go in. It's the same when you come out. You throw as much money at it as you can, and then they did it. But you can't put all that money into the economy right away. So it goes into investments, and that lifts all the markets coming out of the recession. But eventually that excess liquidity needs to be used for spending. People going back to work now have to do commuting costs, for example. Companies have to put it into production. If you could go to the next slide, that'd be great. And this is the example. So 2000, I don't think we're any different in the recovery, except the size of the money going in, of 2004 and 2010. What you saw off the bear market low and the dot-com bust in that March of 2003 low, you saw a massive rally, a historic ramp off the low into the spring of 2004. It was at that point that rally was so strong, the economy was beginning to recover pretty quickly, that you went into the summer of indigestion as you wondered what the Fed was going to do with monetary policy. When were they going to tighten? Was it going to be sooner than you expected? That speculation caused an almost 10% drop in the summer. And then you had a return of the cyclicals off of that low into the end of the year. Next slide. The same thing happened in 2010. Off the bear market low in March of 2009, we all remember that low, you had an 81% move to the spring peak of 2010. Then, of course, guess what? They were trying to think of, well, when is the Fed going to have to get super tight? We're up 81%. The economy is beginning to recover from the great financial crisis. The Fed is going to have to pull forward their inflation expectations and rate hikes or quantitative easing pullback. Remember, we had QE1 at that time. That caused an almost 15% drop into the summertime, a summer of indigestion again, surrounding that uncertainty over monetary policy. Guess what happened from that low, Dave? Massive rally in the cyclicals into year end. Next slide. So what we're looking at on this slide is the Russell 1000 growth versus the Russell 1000 value on the top. It's a relative performance chart. I don't know if you've used this, but I know you use it in general, but the 10-day rate of change on this relative performance chart has been a fantastic guide of whether to be in growth or value. So anytime on the green line on the bottom, when you're down there, it means you want to favor growth, the Russell 1000 growth. Above that red line, you want to favor the Russell 1000 value. We are back into the territory, just as everybody's rushing into growth, that this guide is telling us you want to hold off on that and maybe look at value as a trade. But again, as you know, David, I think you did a fantastic job earlier highlighting what I view as the summer of indigestion. We're in this monetary transition phase, just like 04 and 2010. And it's creating this internal volatility in the market. The only place that really hadn't been smoked yet since April, when we downgraded our market view, had been the economic recovery theme. And that certainly happened last week. So now we're just in this plus minus, do no harm environment, in my opinion.
It's fascinating, and I'm struck, Tony, when you're showing these historical parallels coming out of the 2003 period, looking at the 2009 low. Those years after, especially like 2010 and 2004, they sort of follow the classic sell in May, go away playbook, right? You sort of sell in the late, second quarter, and then you come back in the fall and you ride the strength into year end. So you're seeing for this year sort of a similar potential lineup for that. And if so, my question is, how do you play then these next couple months? Is this an opportunity to just raise cash and get defensive, or are there areas where you would expect to be stronger? Is it a chance to look at some of those value areas that have already pulled back a bit?
I think so much of the market has already experienced an almost 10% correction. Our call on April 12th was when the time to take profits, especially in the cyclicals. Remember, the growth stocks did nothing. Even if you look at the chart of Apple that you had before, it's done nothing since last August. So yes. What happened in the early part of the year is you had such a ramp in the cyclical or economic recovery theme, commodities, cyclicals, weak dollar. Those trends had become extreme. So we suggested taking profit in those cyclical names back in April. What we're suggesting now, after the tank that we had over the last couple of weeks, is it may be on an absolute basis, a little bit too early to buy it during the summer of indigestion. On a relative basis, though, as you know, I advise people like you when you were in Fidelity. You're always invested. So where do you want to be invested if you have to be invested? I think as everybody's rushing into growth, it might be worthwhile to, again, look at some of those cyclicals. But again, it's going to be a very choppy environment.
I think the summer of indigestion has legs. That's a great way to describe things. And I think days like today make it feel more and more real. Tony, listen, thanks so much for coming on the show as always. Stay safe, keep the blue side up, fly well, and we'll talk to you again soon.
All right. See you, buddy.
That's Tony Dwyer. Tony's the chief market strategist at Canaccord Genuity in the New York area. He's also the founder of Dwyer Strategy. You can check out him and his work at dwyerstrategy.com. He always does a fantastic job. I managed to get an aviation comment in there after. Before the show, we were talking a little bit about Tony and I. Painfully for me, we were going through flight training at the same time, trying to get our private pilot's license. Tony was incredibly committed and powered through, got his pilot's license, got a number of ratings, instrument rating, multi-engine rating. I still have not followed through and cleared that first step. So in terms of relative performance, Tony has outperformed me in the air so far. But I love his take. It's interesting. We've talked about, earlier in the year, we talked about after 2020 being such an acceleration out of those lows. We talked about how 2021, what's the parallel? We talked about something like 2010, sort of that, choppy period. There are periods of new highs, there are periods of new swing lows. There are sort of, breakouts and breakdowns that suck a lot of investors in. In the end, it resolves positive. And I think that's a consistent feature in some of those years that Tony was showing us, the acceleration after the weaker sort of summer into the early fall. The fourth quarter ended up being pretty strong across the board. There could be an interesting parallel to keep in mind here through the remainder of this year. Let's continue on with our next segment called Compare and Contrast. What we'd love to do is talk about how you can use StockCharts, use charts to compare and contrast two different securities. You may be familiar with the gallery view on StockCharts. So we're looking at Facebook here. If you click on gallery view and then type a ticker like FB, you get this great series of charts. The intraday view will always be first, and then you'll have a daily view and a weekly view and a point and figure view. And it's interesting, by the way, the charts that I'm showing you are unique because I've changed my configuration on the gallery view to use the charts that I like to focus on in each of those periods. When you run it on your login, you might see some different things. There's a little gray message at the top that tells you, for StockCharts members, how you can customize each of these charts to fit with your own process. So I'd encourage you to do that. If you're a power user, you use StockCharts very often, you can customize this gallery view to really be in line with how you use the rest of the platform. That's what I've done with my charts. So that's if you just enter one ticker. If you enter one ticker and a comma and a second ticker, you get this really cool comparative gallery view. We're actually looking at two different stocks on an apples to apples basis. You're looking at the same charts, one versus the other, and you can compare, in this case, JP Morgan on the left with Capital One Financial on the right. I wanted to look at two different charts within the financial sector. And again, I haven't looked a ton at these yet, but just to give you an example of the type of debate you can have, bull-bear discussion, and really thinking about how to relate one chart to the other. Tony mentioned in the interview just now about knowing him through my work previously at Fidelity and at a larger institution. A lot of your time is spent really comparing and contrasting different tickers. Right? You have a lot of assets you need to allocate into different parts of the market. And the question is, well, where's the opportunity, right? And identifying some of those potential places to park. So we're going to skip the intraday view and just start with the daily view and look at these two tickers left and then right, and see how they relate to one another. So I'm noticing with these two stocks, number one, both of them made a new all-time high in June, right, or at least a new multi-year high, and they are the all-time highs. But here we're just looking at the last 2 years or so. As you can see, the peak here in early June on JP Morgan on the left. You can see the same period, early June. There for Capital One. You can see both of these really the last year has been pretty consistent, the last 6 months here, the right half of the chart have been pretty consistently strong. You see both of these have been in an uptrend of higher highs and higher lows. I may make the argument that Capital One has been more of a consistent kind of classic stepwise motion. You can see very little hiccup in the higher highs, higher lows, sort of Charles Dow uptrend on Capital One. With JP Morgan a couple times, for example, here in April, you can see it undercut its March low, where you can see with Capital One, it actually did not. It actually has remained above its 50-day moving average, while JP Morgan has had a couple further breakdowns below there. That brings me to the current, looking at the current chart with JP Morgan. You can see it's broken down through its 50-day, and now it's testing price support. We highlighted, what was that chart that we highlighted? Fifth Third Bank, I want to say, FITB, we just highlighted yesterday, the day before, with a similar kind of pattern to JP Morgan, broken down through the 50-day, testing previous lows from March and April. And the question is, does it hold those or not? So I would argue JP Morgan is at a pivotal point because it's testing price support. It's broken the 50-day, which is sort of the first indication that things are getting weaker. And now it's testing price support. And I think that's the line in the sand. That's the last line of defense. If it breaks that, you have to start looking down at things like the 200-day moving average, the January lows, which is sort of in that same sort of 130 to 132 range or so, which would be the next downside objective if we would break support. We're really bouncing off of a key support level right now to pay attention to. Compare that with Capital One, which is actually still arguably in uptrend mode. It's pulled back and it's sort of broken below its May lows, but broke below the 50-day for one day, and now it's right back above it. So this is more of a classic sort of bull market configuration: higher highs, higher lows, above an upward sloping moving average. So based on that, certainly Capital One seems like a better position, only because one of these has broken down through its 50-day, the other one has not. Another thing that stands out to me is the bearish divergence that you have in Capital One. So while JP Morgan's already rolled over and broken down, you can see this bearish divergence May into June, where Capital One's made a new high. But look how the momentum's actually sloped downwards. The momentum's actually coming out of that uptrend. In the end of the day, bearish divergences, I think, are good early warnings. Actually breaking down of support is the real signal, I would argue. That really indicates that distribution is happening, not that there are signs indicating that it may start to happen at some point. So overall, given the two, I would argue Capital One is in a better position, especially on a relative basis, where the relative strength is more consistently positive, whereas JP Morgan has really been sideways, made a new relative low here in the last week or so. On the weekly chart, you can find some of the similarities here. Both of these stocks obviously sold off pretty good going into the March 2020 low. Arguably Capital One had a much more painful ride, really blowing out multi-year lows. You can see both of those recovered, and in the first quarter of 2021 sort of made it above their January 2020 peaks. So both of those have made higher highs in there. Both of them have been recently overbought on the weekly charts and have come out of that overbought region, I think, in both cases. Both of them have had bearish signals from the PPO or the MACD in the last couple months, indicating an exhaustion of this uptrend. So I think the weekly charts, I would argue, are probably similar. So if I had to decide between the two, I would most likely be opting for Capital One, which is still arguably in bullish mode, the RSI bouncing off of 40, the relative strength consistently positive, whereas JP Morgan has recently become oversold with an RSI below 30. The relative strength is more flat to down, and it's testing a key long-term support level. That would be how I would articulate the differences between those two, and really the compare. I mean, how they line up very similar. The weekly charts are not that dissimilar. The daily charts is where you can maybe compare the two and contrast them a little bit more. We need to wrap the show. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the relative performance of small caps. This is the ratio of the IWM versus the SPY. So if this line is going up, small caps are outperforming. If the line is going down, small caps are underperforming. You can see the down move in this ratio, March into April. You can see the sideways move in this ratio, April and May. Arguably now you're seeing a bit of a rotation back to the upside with a break to a new swing high and potentially making a new swing low. And this rotation back into small caps over large caps, certainly outperformance in sectors like financials and energy would fuel that ratio going higher, because the small cap indexes have less tech, less growthy stuff in some ways, and more things like financials. But I'm seeing a rotation higher, which tells me leaning into small caps may be an opportunity here going forward. Look at a stock breaking out and a stock breaking down. Costco, I had a question on Costco in the last 24 hours on my YouTube channel called Market Misbehavior, and someone mentioned Costco about a defensive or an underperforming sector like consumer staples, but a stock making new swing highs. And it reminds me that in any environment, you can usually find charts that look like this, charts that are breaking to new highs, breaking out of bases. I don't mind the chart of Costco at all. The relative strength has been pretty good over the last couple of months. It's breaking out of this resistance area. And I think as long as that breakout level holds, it's a pretty interesting breakout. It's sort of flat today after yesterday's rally, but overall, I would like to see if that trend is able to continue. What sort of charts are rolling over? What I would also say, even when the market is doing well, you will always find charts that are probably breaking down. And in that same sector, consumer staples, CAG, is probably a good example of a chart that I would tend to avoid. Breaking below the 200-day moving average, breaking below a pretty major low there in April. I think heading back down to the low 30s, which would be the support areas from earlier this year and also last year. Relative strength making a new, arguably 12-month plus relative low. That's a tough chart to want to hold right now. Oversold right now, which means you could have a bit of a bounce. But overall, I feel like the path of least resistance may be lower. That's our show for today. Special thank you to Tony Dwyer from Canaccord Genuity and Dwyer Strategy joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.